Welcome to SkyBridge Views. I'm Anthony Scaramucci, the founder, co-managing partner at SkyBridge Capital. I'm here with Troy Gayeski, who's also a partner here. He's the senior portfolio manager on our team. And the goal here, Troy, is let's have an open conversation about what's going on in the markets. And let's talk about the headlines right now. Let's start off with what you think the outlook is for the global economy.
Well, unfortunately,
I think your makeup looks good today, by the way.
It looks sharp. It looks good.
Doing a good job.
Your hair looks good too. I have to
thank
say
you.
that.
Thank you.
No, but
what do you think's going on?
No, look, we're in a 1.5 to 2% growth environment. Unfortunately, at least for the next 12 months. It's hard to look out further than that. But the U.S. consumer is too strong for us to slip into a recession. That being said, obviously, corporate America has struggled in terms of profitability. CapEx has been extremely weak. Trade has been weak, and manufacturing has been weak. Although it looks like it's turning around. So, you know, unfortunately, unless we change our political policies in terms of growth, it's going to be hard for us to break out of 2% growth in this cycle.
Yeah. So this is an interesting thing, and a lot of people ask me about this, so I'm going to ask you. China, billion people, 1.5 billion people, grow at 6-7%. They say that's a slowdown. India growing 4, 5, 6%. They've got roughly 1 billion people. And so why is the West having such a hard time growing? Here in the United States, we have about 323 million people. We've got this phenomenal capital market structure, phenomenal legal system, intellectual property rights. We have all the ingredients to grow. Yeah. Now, if you go to my Twitter page, people say, well, you can't grow, dummy, because it's the law of large averages. Yeah. You've got a $17 trillion economy, and you're never going to be able to move the needle. Do you believe that, or do you think that we can get growth back up to what was historically normal for the United States?
Yeah, I don't think we're ever going to see Reagan-esque growth again, but we have a chance to...
So Reagan-esque growth defined for SkyBridge
5-6% per annum, yeah.
Okay. And could you get to the 4% number?
It's possible inter-cycle. I think the key, though, is to be realistic to get it to 3. That's the way we look at it, is that if we're growing at 1.5 to 2, are there policies you can pursue to get it to 3? And there are. It's just a question of Washington cooperating. You need pro-growth tax reform, which obviously the left doesn't like because it widens out inequality, but it grows the pie. More importantly is regulatory reform. I mean, regulatory reform has been the wet blanket on this recovery. And when you think about Washington, they're involved in just about every industry now. Healthcare, telecom, energy. I mean...
So you think the economy's overregulated?
Oh, by far.
So why... I mean, the government is supposed to be serving the people. The definition of the people that are in the government is that they're public servants. So why are they not serving the public? What's the disconnect there?
Well, it's one of the breakdowns in democratic society where you have such a distance between the voter and the bureaucrat that's implementing the laws, right? I mean, you have a sprawling executive branch, you have unaccountable bureaucrats, and they're not bad people, but their goal is not to increase growth.
No, I'm not saying they're any bad people, but they're doing something that I think is systemically bad for our society. The overregulation, the theory behind the overregulation is to make people safer.
Yes.
But the problem is that the animal spirits that John Maynard Keynes talked about, if you're trying to overly restrict the animal spirits of the human being, you get less than expected growth. Exactly. And then you got all sorts of other problems because you can't catch up on the entitlement funding and all the other things that you want to do in your society as it relates to infrastructure. So you're better off taking a little bit. Did you take risk in your career, brother?
Of course.
Yeah, me too. So you're better off taking the risk because the risk is going to lead to some level of incremental reward. And even if there's some setbacks, I'm just always amazed by these governmental bureaucrats that are like stymieing and stifling things in the interest of what they think is protecting the public, but it's having the absolute opposite effect. The people can't get jobs, people.
I mean, the principal problem is there's no cost-benefit analysis.
Right.
I mean, you can regulate every industry into the ground, but then you're never going to get the output of the industry. They've done a great job putting the coal industry in a tough patch. But if they really don't like the coal industry, let market forces do its work, right? If there's cheaper alternatives, then hey, the coal industry might go away. But you shouldn't impose penalties.
He's spoken like a true Pennsylvanian there.
Yeah, I grew up in Scaramucci.
Yeah, right. So we all see these things from the perspective of our upbringing. So let's talk about the outlook for the financial markets, and should investors be fully invested now?
You know, if all you can invest in are bonds and stock, we'd suggest that you step back a little bit and put a little cash on the sidelines. If you can invest in alternatives, that might be one way to go and not be overweight stocks and bonds. And the reason we say that is if you look at where we are in the cycle, we're obviously later in an economic cycle. We don't expect a recession, but we could be wrong. More importantly, most vanilla asset classes are extremely expensive. Bond yields are extremely low. High yield bonds offer the lowest loss-adjusted yield since the crisis. Equities could certainly get more expensive, but they're trading at post-crisis highs and multiples. That doesn't mean we're going to have a bear market. That doesn't mean the world's going to end. But on a go-forward basis, it looks like volatility is going to pick up, and the return from those assets will be meaningfully lower.
Well, obviously, you and I agree with that. That's why we're partners. But what about the hedge fund industry? Okay, so our listeners, our customers, the media, the politicians, there's a drumbeat of hatred towards our industry. And by the way, the industry has not done super well.
Yeah.
And so what does that mean, Troy? Is this a good time to invest in this industry or not?
Well, look, a lot of the criticism is sensationalism by the media. Most of it is not fundamentally based. You look at this industry, it's gone through a tough period recently. Every asset class goes out of favor periodically. But the reality is, if you look at the actual data, 6 of the last 7 months, hedge funds have outperformed broader markets. The last 3 in a row, they've outperformed bonds and stocks. So when you think about that in a relative comparison, if all you're going to focus on are 1 or 2 periods where the hedge fund industry struggled, then you can cherry pick that with any asset class. Emerging markets have struggled for years. Now they're the best performing asset class out there. We're not promising fantastic outcomes. We're just saying that after going through a tough patch, the hedge fund industry is back to doing what it does well, which is generate reasonable returns with low risk of loss.
Yeah, so you're again. I mean, I say this to people, and you and I just did an event at one of the platforms where we talked about the need to have some slice of your pizza pie of asset allocation in our industry. It doesn't necessarily have to even be SkyBridge, but it has to be somewhere where, from a tactical asset allocation perspective, you have 5 to 15% of the portfolio in non-correlated assets away from stocks and bonds that can help you reach your long-term actuarial goal, but also dampen the volatility of the portfolio. Because, Troy, what do we both know? That when a client, I mean, this is true about everybody, myself sometimes included, I have to check myself, that we are long-term investors until we have short-term losses. And so what ends up happening is you go through a rough patch, people set their hair on fire, they run around in a circle, they yell at their FA, they yell at you and me.
Yep.
And the real thing for them to do is to stay the course and to be patient. So the financial industry has seen a major shift now from what I would call the active management, which include hedge funds, mutual funds, things where there's an active portfolio manager, and passive indexing strategies and exchange-traded funds. Is this a structural change?
Yes.
And permanent or cyclical?
Well, it's structural if you think in terms of 5 or 10 year increments, right? So that tends to be our longest time horizon. We invest based on a 6, 12, 18 month increment. But the reality is, for a lot of the active managed industry, there hasn't been a lot of value added, particularly in equities. And part of that is because mutual fund managers are so constrained by their benchmarks that they can't possibly add value. So if you can't add much value, and what little value you can, it gets arbed away or reduced by fees, then it's very hard to make that a business long term. Yep. So we think it's certainly secular in the equity part of the capital structure, and won't change at least over the next 5 to 10 years.
What typically happens is you get a great migration into an area. People moved into subprime. You had the Community Investment Act where the government was asking people to do things that ended up turning out to be bad ideas. Now the cabal is to move into exchange-traded funds and index funds. As the Federal Reserve is normalizing the interest rate cycle and bringing interest rates back into play, and you and I both agree that price discovery will enter the markets again. Is that fair to say?
Correct.
Isn't that going to be a potential cyclical potentiality of downturn for indexes and
yeah, so I
passive
think that's a cyclical versus secular. So the secular trend is for lower fees and more passive, but the cyclical is when the interest rates do go up.
So you got to be careful, basically, right?
Yeah, no.
I mean, that's the biggest message that we're trying to give to people.
Yeah. What I think it's important to add, Anthony, is that, remember, there are many asset classes where you can't access via ETFs. You can't do these low-cost funds to add value. And in those markets, whether it's mortgage-backed securities or distressed corporate credit, those are areas that hedge funds and, to be fair, private equity managers still add meaningful value. And again, if you can generate a well above mid-single digit return, and by well, we mean a couple hundred basis points, we don't mean 10 or 15, and do it in a way that diversifies your risk, then to your point, as the monetary policy tightens, that will be to clients' advantage as a lot of their passive strategies suffer.
Right, so it's important, but the message there is to have a little bit of everything, okay? That's the super important thing. SkyBridge made significant changes in our portfolios on the fund-to-fund side. Explain the decisions. How have they fared so far?
Yeah, so look, we had a tough choice to make at the end of last year and early this year. One of our largest theme actually at the time was performing poorly. It was focused on hard corporate activity, mergers, acquisitions. And what we activism as well. Yeah, activists were one part of that. And look, when we look at any strategy or theme, what we see is the theoretical opportunity, which we thought was great, and then the empirical outcomes, which were less than great. A lot of that stemmed from the politicization of the healthcare industry, as we continue to see healthcare stocks in particular get hurt by that. But in any event, our view was M&A had nowhere to go but down. If it was tough for managers to make money when there's booming M&A, it probably won't get better when there's less. And more importantly, there were finally opportunities to do in complex fixed income strategies again. This is an area we made a lot of money in historically, but the problem was from 13 to the end of last year, there was really nothing to do there. So when those opportunities arose, we started to rotate capital there. And now we have a portfolio that has substantial amounts of cash flow. We think has much less downside than equity markets and can hit a competitive return.
Biggest risks to the market and the economy right now? Europe, China, what do you think?
You know, the biggest fundamental risk over the next 2 to 3 years is still China having a hard landing and having their debt bubble implode and being forced to a major devaluation. That's the largest transparent risk that we're aware of.
So assess the probability there, 15%, 20%?
Yeah, 15 to 20%, we'd say. You know,
so it's not crazy probability. That's another big problem. People read the journalists or they watch the TV and, oh my God, China's going to blow up, or you get all these. How do you get airtime on television? You say something crazy, right?
Yeah.
So, I mean, so it's only a 15 to 20% probability. They're probably still going to be okay, right?
Yes.
Still have a lot of currency reserves.
The most likely outcome is they make it, they find ways to delever their economy and continue to grow. Again, growing at 6.7% is not a bad number, particularly compared to the developed world.
Amen.
And so, you know, when we think about that, if we had a lot of emerging market risk, we'd be very concerned about that.
So that's important. We don't have any emerging market risk.
We don't.
Okay, so why don't we?
Well, we're not bashing emerging markets, but, you know, emerging markets have...
We are a little, probably.
Yeah,
but
no,
go ahead,
we're not bashing.
Because
If someone made a cogent argument right now that we've started the turn in EM, I think it's believable now after 4 bear market rallies. But the point is if you own emerging markets and China has a hard landing, it's going to be a really bad day. You're going to get clobbered. Right. So even though we're worried about China, we're less worried because our exposures are primarily U.S.-based and will be fairly resilient to the outcome.
So it's very important to understand that in the context of your portfolio is that you have to have a really good understanding of what you own, and you also have to have what I call the Surgeon General's warning label on all these different products. And the thing I love about him, which I'll say, and I'll pay you a compliment. Let me
thank you very much.
Dust up your hair a little bit,
just
but
don't mess up the hair, you know?
But the thing I love about him is that he's constantly worried, and he knows he's going to get things wrong. And so one of the reasons why we have a dynamic movement in our portfolio, in addition to our themes and our concentration, we move quickly when we get things wrong. I give you a lot of credit for that, Troy. I want to talk about, before we go, long-term effects of low and negative interest rates around the world.
Well, I think from an investor standpoint, the biggest negative, of course, is just expected returns have compressed dramatically. I mean, it used to be you could invest 60-40.
And that's brought hedge fund fees down. It's important to point to people that we have gotten big discounts from a lot of these hedge fund managers, right?
That's correct. We have gotten substantial discounts, but in terms of return expectations, all asset classes that are vanilla and easy to access are fairly rich right now. Interest rates are very low. So outcomes have to be adjusted much lower in those assets. So that's our biggest impact from an investment standpoint. From a global standpoint, you know, it's something you talk about frequently. It's a symptom of the fight against deflation, right? So who wins? Do the central banks win and reignite inflation, or do deflationary forces win? Time will tell, because if deflationary forces win, interest rates are going even lower.
Well, listen, I mean, there's only one tonic for deflation, and that's growth. And so, not that any government officials are watching this program, but listen to me. We got to change the footprint of our regulation and our tax structure and incentivize people to grow. If we grow, the central banks will be something we don't have to worry about, and they won't have to worry about deflation because you'll be growing. My last question for you, Troy. U.S. still the best place to invest?
You know, we still think it is in terms of, again, risk-reward. I think you could make arguments that places like Greece, for instance, have tremendous upside. And we agree with that, but the risk is very high. So we look at everything from a risk-reward lens. And right now you have the U.S. economy doing relatively well. You have a variety of robust asset classes like the U.S. housing market. You have securities that throw off a lot of cash flow that are relatively cheap, at least compared to where they've been through most of the post-crisis period. And you put that all together, and to us it means maybe not make the best return of anything out there in the next 12 months, that's fine, but put up a competitive return and do it in a way that has much less downside.
All right, well, Troy, I want to thank you for joining us. I'm Anthony Scaramucci. We'll see you next time on SkyBridge Views.
All investments are subject to risk, including the possible loss of the money you invest. For more information about SkyBridge Capital Multi-Advisor Hedge Fund Portfolio Series G, call 1-888-759-2730 to obtain a prospectus. Investment objectives, risks, charges, expenses, and other important information about a fund are contained in the prospectus. Read and consider it carefully before investing. This webcast is for educational purposes only. We recommend that you consult a professional advisor about your individual situation.